Herman, 2023 has been a year to forget for US regional bank investors, with the KBW Bank Index down 18% versus the S&P up 18%. Investors have had to contend with 3 bank failures, an aggressive Fed interest rate cycle, tougher regulations, and weakening credit outlook. How do you see 2024?
Thanks, Roger. That's right. 2023 has been a year to forget in a lot of ways, but the good thing is that deposit bases have stabilized following the turmoil in March and April and May. And in the meantime, we're not seeing a lot of loan growth within the industry. That's something that will challenge revenues for 2024. Margins have the potential to stabilize if the Federal Reserve is done with its rising rate cycle, so that's a positive as well. Still, there are a number of challenges outside of loan growth. Tougher regulation, as you mentioned earlier, that has scope to weaken the profitability outlook for regional banks, and there is another shoe to drop potentially with respect to commercial real estate and in particular office exposure. So that's something to look out for 2024. 2023, asset quality has been really stable. There hasn't been too much to discuss in terms of weakening credits, but some early indicators like criticized loans is something that we're watching, and those early indicators are showing a potential weakness ahead.
And a more dovish Fed, how do you see that really playing out for net interest margins?
Yeah, I think the industry would welcome Fed rate cuts. That's something historically that has been a negative factor for banks, as banks' balance sheets are rate sensitive, meaning that rate cuts would potentially weaken net interest income. But what we've seen, at least this year, is that funding costs have really ratcheted higher because of the aggressive rate hikes and also the need for banks to be defensive in terms of preserving their deposit bases after the bank failures earlier in the year. So any rate cuts would help alleviate that funding pressure and would be positive for net interest margins potentially going forward. So that we're expecting some stability in margins even without Fed rate hikes, but Fed rate cuts, but any potential cuts would be additive potentially.
And are investors right to be fearing their bank's commercial real estate exposure?
Yeah, that's something that remains, in my view, more of a headline risk than actual hits to banks' balance sheets. Office commercial real estate exposure really is about 2% on average in terms of our coverage universe, so really a small subsection of its diversified loan portfolio. That being said, there is risk and there will be losses. We are seeing banks already prepare for those eventual losses. They're building reserves, and we're seeing certain banks in our coverage universe have reserves on their specific office portfolio at 8, 9, 10%. So that's something that should offer plenty of cushion in the event of defaults and eventual loan losses. But it does nonetheless create some risk for the industry because there are smaller banks that do have higher exposures. And we've seen from at least the third quarter earnings reports that any sort of hiccup in terms of early indicators of non-performing loans within office does tamp down bank stock prices. So that's something to watch out for going forward.
And how are regionals positioned for the phasing in of the Basel III endgame rules?
Right. So tougher regulation is something that the regional banks will need to contend with going forward. That is on a number of prongs. The most arduous will be unrealized securities losses within their, will be incorporated in their capital calculation. So that has scope to really drive down capital, and the market's already reacting to that as certain banks, for example, like KeyCorp or Truist have been a bit weaker relative to peers on their capital ratios, and that's been a big focus for regionals collectively. What we do see is that the regionals will continue to build capital, which means they're not going to be largely buying back stock next year, and they're curbing their appetite for lending, which is another form of preserving capital ahead of tougher rules that are expected to start to be phased in starting in 2025. So the banks do have time to really get their house in order, but it is something that is a question mark for the industry going forward.
Thank you, Herman.